Hey everyone, Anthony Venuti here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to be talking about what happened in the US with SVB Bank and what does it mean for the US economy and the Canadian banks right here at home. Stay tuned, you don't want to miss it. In light of the events that are unfolding right now in the US, and as they evolve, we are starting to see a lot of pressures in the financial system, and these cracks are starting to show. What happened with SVB Bank collapsing in the US? How did the US government handle it? And what could it mean for policy rate decisions moving forward? And a lot of Canadians wondering, well, how are these things that are happening in the US impacting Canadians and Canadian banks? It is actually a widespread issue, and it has brought a lot of attention to not only the US banking system, the regulatory policies and procedures that are in place, but obviously what happens now with other banks, right? Are they paying attention to what has happened in this higher rate environment? Now, I want to take an opportunity to talk a little bit about what happened with SVB Bank. Very high level, it is a tech-based company, bank out of California. They have about 45 to 50% market share of tech startups, hence the Silicon Valley. So it is the 16th largest bank in the US and the second largest bank to actually collapse next to Lehman Brothers in 2008. So they are significant to some regard. So obviously understanding their market is very important because as 2020 rolled on and we started to see a lot of these tech companies explode, they went public on the IPO and they started being flushed with cash. So, and when you're flushed with cash, well, these companies will tend to deposit into their accounts in order to basically, run their day-to-day operations. And the more money they're making, the more money they're depositing, they're able to burn through cash at a rapid pace. But because they have shareholders, they have investors, they have all this equity that's being injected in these companies when rates are low, while they're flush with cash. Now, what happens with SVB Bank and some banks, or pretty much most banks, if you look at fractional reserve banking, while they're required to have a very minimum amount of about 10% of the deposits liquid in cash in the event of people wanting to withdraw them. So they have to have some cash in hand because not everybody can deposit in a perfect world. Not everybody's going to withdraw their money at the same time. A lot of people are going to be depositing. Now, because the bank itself was not able to loan out all this money as quickly as it was coming in, while they needed to basically put this money to work for them in order to pay depositors, they want to basically lend out the money and they want to charge an interest rate. And that difference is the profits, the spread, and the difference they wanted to park in US Treasuries. Now, US Treasuries is a smart decision for most banks. It is a very safe investment. Many banks do this across the board. There's nothing wrong with it. As long as there is a portfolio manager, a chief risk officer who is looking at the current situations and assessing their weighting balance, how much their liabilities to assets are, long-term duration, short-term duration, mark to market, what are they worth today? What are they worth when we mature them, mark to maturity? So there's a lot of things that a chief risk officer would be doing. The problem was that SVB Bank didn't have one from April of 2022 till January of 2023 when they hired someone else. And because at this pivotal point in time, we started to see the US Fed and the Bank of Canada, many central banks started to increase policy rates in order to tackle inflation. And this had a very negative impact on a lot of these long-term duration bonds, which ended up showing some significant cracks when they tried to liquidate a lot of these bonds. They had to take a haircut. They had to sell them. They had no choice. They couldn't hold them to maturity. They needed to pay all the withdrawals out. And this is where the problem unfolded. Now, this begs the question, a few different questions. Obviously, is it the US Fed that increased policy rate and, hey, this is something that they didn't think about. They should have been conscientious about it. What is moral hazard? Basically, in the sense that, if you think about what has happened with the government, now the US Fed, the US government, I should say, Joe Biden coming out earlier this week saying, hey, we got you. Don't worry, Americans. We'll backstop this. We'll make sure that all depositors are made whole.
First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business.
Because SVB Bank had to basically be taken over by FDIC, which is the Federal Deposit Insurance Corporation. This is the arm of the government that's responsible for insuring deposits $250,000 or less. If you have $250,000 or more, well, unfortunately, you don't get covered. But the government is saying, well, don't worry about it. We got you. Nothing to see here. And this is where the things get a little bit sticky because banks like SVB Bank that missed oversight, maybe their policies and procedures, this loophole where they don't have to show potentially their actual realized losses, what their actual bonds are worth at the current moment. They can just show the face value and not necessarily what they're currently worth in this market, has led the regulators to sort of question this. On top of that, the chief risk officer not being there, interest rates, so on and so forth. So this bank definitely had misstepped, a lot of failures that happened in that particular bank and others like them. But this moral hazard means that, well, what about the banks that operated in the proper ways, that were looking at all these things, had a chief risk officer, looked at their maturities, and were hedging their bets to ensure that if rates go up, well, they're covered, right? Those spreads, if there's a run, if something happens, they could sell these assets and they got enough money to cover the withdrawals. This question is like, well, now these banks maybe made a hedge or a bad bet, maybe a good bet if it would have paid off, but a bad bet at the current moment. Why can't these other banks now say, hey, well, they did it and they got away with it. Why can't I do it and get away with it? Because the government's going to backstop everybody. So this is where a lot of people are getting some slack to the U.S. government on the way they handle it. And obviously, as things unfold, we're going to see exactly how it happens. Now, Joe Biden did say that the FDIC, which is the Federal Deposit Insurance Corporation, is going to pay basically for the actual differences in those deposits that were over 250,000.
No losses will, and I want, this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions of that, because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
You know, this is something that the other banks are questioning, saying, hey, we did everything right. Now we have to pay a premium because they messed up. They're crying foul. And obviously, there's a lot of people that may have sympathy for the banks or not have sympathy for the banks. But at the end of the day, those costs end up coming from somewhere. These insurance premiums get paid by someone, and these losses get paid by some people. So we have to look at what is happening there. Now, obviously, all these ramifications of what's happening in the banking system are having a major impact on the US Federal Reserve, because not only is it combating the inflation numbers that came out on Tuesday that came in hotter than expected. And don't forget, last week we were talking about raising policy rate 50 to 75 basis points, right? Because they want to tackle inflation. Well, that was when things were running smoothly. Now that things are sort of choppy and some pressures in the financial system are starting to show signs of weakness, well, the US Fed has to make a decision. Do they proceed with increasing policy rate 50 to 75 basis points, further putting pressure on the financial systems? Do they pause like Canada did in order to maybe take a step back and see exactly what is happening? And is it going to be a long duration pause, or is it going to be just a quick one for one cycle to say, hey, let's see how things are playing out? Or some economists are predicting that they might even cut rates because of what's happening right now. Now, I'm in the camp that I don't think the US Federal Reserve will end up cutting rates at this particular point, because I think it's a very centralized problem with some of these regional banks. It's not a entire banking problem like we saw in 2008 with mortgage-backed securities. So obviously, and then you have the US Fed looking at the pressures now from a recession, right? Because if we start to see inflation, what could happen with the job numbers? This is a major question, as many economists believe that the US is obviously already in a recession, or it could be a deeper recession. So the Fed is literally fighting three fronts right now. They're fighting the financial system, they're fighting inflation, and they're trying to avoid a recession. So obviously, all these implications in the US are bleeding over into Canada and to other central banks and other banks in the world, because a lot of them are asking themselves, well, hey, because of what happened in the US, we should take a deep dive and look at our banks. And OSFI, the Office of the Superintendent of Financial Institutions, did just that. Peter Rutledge came out earlier this week saying, hey, we want our banks to basically provide us with statements each and every day on closing that they have liquidity on hand, and that the banks need to basically ensure that they have all this money in the event something like this happens. So there's a lot of scrutiny happening here in the Canadian banks. Chrystia Freeland, the finance minister, also indicated that our Canadian banking system is better regulated, I believe, and well insulated. And she's pointing to the strength in our banking system. And that is sort of true. I do believe there are some significant, downwards pressures on the banking system, but we are seeing an influx of capital and cash coming from these withdrawals into other banks, and most importantly into Canadian banks. So this does show that there are some signs of resiliency in our Canadian banks. Now, obviously, talking about the resiliency, some of the pressures, obviously, these trillions of dollars in loans and mortgages that are outstanding. Yes, the banks had to put around $2.5 billion aside as for OSFI regulations to ensure that they have the money to cover a lot of these loans in the event they go south. On top, I would probably say for someone who's worked in the banking system, you wouldn't have a chief risk officer, someone that important to the banking hierarchy, missing for, unless they're on holidays, missing for more than, let's say, a week or 2 weeks. They would find someone and replace that person immediately. And obviously in Canada, we have very tight regulations. There's almost over redundancy when it comes to these types of jobs within the banks. Now, just to end off very quickly, how does this all play out? What's the benefit here? What's the silver lining, if any? Well, obviously the markets are taking a beating, but withdrawals, massive sell-offs in the banking sector, but we have seen the bond prices come off significantly from their highs. And just a few months ago, where they were at their top around 3.6%, they've now recessed back all the way below 3%. And I believe that in the next few weeks, as the risk appetite for these banks start to be realized, they start to see things settling down and things start to calm down. Well, we might see a lot of these discounts being passed on to the consumers and the borrowers right in time, potentially for the spring market and moving forward. But obviously, this is temporary right now. We need to see what happens with the US. And we're going to be hearing from our inflation numbers coming up next week, and obviously the US Fed next week as well. So those are some things that we're going to be paying attention to. And if those are things that interest you and you like to find out more about it, we invite you to kindly like, share, and subscribe to our channel. Hit that notification bell so you can be notified every time we post a video. Let us know in the comment sections below what you think will happen with the US Fed and their policy rate decision next week. And how do you think that will play out? Leave us a comment below. Let us know your thoughts, but we'll leave the video here. Wishing everyone a wonderful Friday and even better weekend ahead. Thanks for watching. Thanks for clicking. We'll see you next week.